So this is chapter 16 of your book, and this is cash and cash flow, importance of cash, difference between cash and profit, and inflows, outflows, net cash flow, opening and closing balance. Right, so this is your chapter 16, importance of cash. Cash is very important for the business. It refers to the money readily available for a business to spend. It's basically used for day-to-day running of a business. So if you have a question, what is cash used for? It's used for paying suppliers, employees, and overheads. Never say for expansion, etc. So to pay the suppliers, to pay for your stock, to pay immediately or using trade credit, employees, their wages and salaries, overheads like rent, insurance bills, etc. To prevent business failure, which is called insolvency. Insolvency is a stage when business cannot pay its bills. Having sufficient cash and not having too much debt will help a business to avoid insolvency. A business cannot operate without staff stock, so that's why cash is very, very important for any given business. Difference between cash and profit. Many profitable businesses fail because they do not have enough cash to pay their bills. Profit is recorded straight after a sale is made, whereas cash is recorded when it's either spent or received by the business. If a business offers trade credit, then the sale and therefore profit are documented, but cash will not be recorded until the payment is received. How should cash be managed? So these are the 3 ways. Overdraft, negotiate generous overdraft facility, keep costs under control, keep the cash coming in. So that's the way to manage your cash. Right, so this is your cash flow forecast, chapter 17. Cash flow is money coming in and out of the business, and cash flow forecast is predicting the movement of money over the next few months, over a future time period. So this is a prediction. Cash flow forecast will show its likely effect on the bank balance. It is important for every business, particularly seasonal businesses, so they can point out the months which they do not have enough cash inflows, but they might have bills to be paid, so they can arrange for their cash. Poor cash flow is a major reason why many new businesses fail. Inflow, money coming in the business, revenues, bank loans are the examples. Outflow, money going out of the business like rent, payments, salaries. To calculate the net cash flow, inflows minus outflows, memorize this formula. Opening balance is the amount a business has on the first day of the period. So it's basically closing balance of the previous period. Closing balance is what business has on the last day, so it's opening balance plus net cash flow. To improve their cash flow position, organize overdraft, review their outflows, reorganize trade credit periods.